If your cryptocurrency holdings are idle at the moment and you'd rather be earning interest on them, you may be interested in yield farming. Don't worry if that sounded Greek to you. For the rest of this video, I'll tell you exactly what yield farming is, how it works, whether it's profitable, and its risks. I hope this information will help you to decide whether you should start using yield farming to boost your cryptocurrency returns. Stay tuned. Hello and welcome to CryptoSpeak. I'm Josh. Let's now learn what yield farming is all about and see if you should consider it. What is yield farming? Simply put, yield farming is using your cryptocurrency holdings to earn interest, just as you would earn interest on the money in your savings account. And like depositing money in a bank, yield farming involves staking or lending coins or tokens in exchange for interest, transaction fees, or other rewards, such as more coins or tokens. Yield farming is one of the many avenues for crypto holders to earn income created by decentralized finance, or DeFi, a relatively new financial technology that aims to remove intermediaries in financial transactions. In fact, yield farming is currently the biggest growth driver in the DeFi sector, helping it grow from a market cap of $500 million to $10 billion in 2020. As of posting this video, yield farming is the most popular method of profiting from crypto assets. How are yield farming returns calculated? Yield farmers and most protocols and platforms estimate their returns in terms of annual percentage yield, which is APY, which is simply the rate of return gained over a year on a particular investment. Compound interest, calculated regularly and applied to the amount, is factored into the APY. How does yield farming work? People who provide their crypto assets for the functioning of a platform are referred to as liquidity providers, or LPs. These liquidity providers provide their crypto to a liquidity pool, which is essentially a smart contract-based decentralized application, or dApp, that contains all the funds. Examples of dApps include crypto wallets, decentralized social media, and decentralized exchanges. DEX. Moving forward, once the liquidity providers lock their crypto into a liquidity fund, they are awarded a fee, or interest generated from the underlying DeFi platform the liquidity pool is on. And just to note, since the lending happens through smart contracts, there is no intermediary or intermediator involved. Why is yield farming popular? As you probably know, interests offered by traditional bank savings accounts are remarkably low. However, yield farming allows those participating in decentralized finance to earn higher returns on their holdings, making it an excellent way to grow capital. Plus, the very idea of earning returns from idle cryptocurrency holdings continues to draw more and more people, hence the increasing popularity of yield farming. Now, the question that's probably on your mind right now, is yield farming actually safe? Well, the investment model doesn't come without risk, considerable volatility. Crypto as a whole is volatile. We have seen cryptocurrencies rise and crash massively, especially in the past year. So depending on how the market performs and the coin you invest in, your investment can lose value whilst tied up. Risk of fraud or scams. The cryptocurrency market isn't quite regulated, so there are projects out there that aren't particularly honest. You could put your money in today, and weeks down the line, the developers carry out a rug pull, and poof, just like that, your investment disappears. Malicious attacks. Yield farming is governed by smart contracts, which need to be secure. In case of a bug or a hacking incident compromising your smart contract, your crypto could be at risk. Regulatory concerns. Even now, regulation in crypto is still a grey area. There's a lot to understand regarding regulations and jurisdiction when you want to get into yield farming. Now that we've covered the safety concerns, can you make good returns through yield farming? Definitely! Yield farming is, without a doubt, risky. However, it does have the potential to make you good money, which is why it is so popular with crypto investors. Usually, yield rewards are between 5 and 14%. However, if you invest early on in a crypto project, you could earn 100 or even 1,000 times much more. Assuming the market remains relatively stable, the profit you will earn through yield farming will depend on how many coins or tokens you've staked, the annual percentage yield, and how long you keep your crypto locked up. The 5 most popular yield farming protocols. So where can you get started with yield farming? There are probably dozens of staking and lending platforms out there. Here, however, I'm going to mention the best 5. Aave, Compound, Uniswap, SushiSwap, and Curve Financial. If you're looking to compare yield farming protocols and liquidity pools, CoinMarketCap provides rankings with daily APY updates. All things considered, is yield farming for you? That depends on your goal and risk appetite. But then again, you must be able to handle risk if you want to venture into crypto. Yield farming may be a good idea if you're not particularly into day trading and prefer a buy and hold strategy to make you money passively. If you have low to moderate risk, stick to staking. If you're a bit of a risk taker and want to maximize your returns, you could look into DeFi lending and liquidity pools. There are plenty of options if you're looking to invest in the crypto industry, and yield farming is one of the options to multiply your crypto you can explore. Are you willing to try it? Drop your answers in the comments below. And don't forget to like the video and subscribe to CryptoSpeak for more educational videos in crypto. Thanks for watching. I'm Josh. I'll see you in the next one.